It's the final day for this week on Business Morning. Welcome and thank you for joining us. I'm Chimeze Obi Iwag. We'll begin with a global oil market update as crude prices fell in early trade as the resurgence of the coronavirus globally and in the United States, the world's largest oil consumer, dimmed the prospects of fuel demand recovery. Brent crude futures were down 37 cents at $42.77 a barrel, and U.S. West Texas Intermediate crude futures fell 34 cents to $40.31 a barrel. Both benchmark rose more than 2% on Thursday, buoyed by stronger than expected U.S. job data and a fall in U.S. crude inventories. For the week, Brent was up 4.3% and WTI was up 4.7%. However, increases in the daily cases of the coronavirus globally and in the United States pressured prices. New U.S. COVID-19 cases rose by more than 50,000 on Thursday, setting a record for a third consecutive day. Gasoline demand will be closely watched as the United States heads into its July 4 holiday weekend, as many Americans are expected to hit the road. U.S. gasoline stocks rose by 1.2 million barrels in the week to June 26, according to data from the Energy Information Administration released on Wednesday. Meanwhile, recent data from the National Bureau of Statistics shows that the volume of petrol imported into the country in the first 3 months of the year rose by 9.24% compared to the same period in 2019. The country imported 5.32 billion litres of petrol in the first quarter of 2020, up from 4.87 billion litres in the first quarter of 2019. Aside from petrol, a total of 1.66 billion litres of automotive gas oil, that is diesel, was imported in the first quarter. Also, 258.27 million litres of aviation fuel, 28.33 million litres of low-poor fuel oil, and 135.14 million litres of liquefied petroleum gas were imported into the country in the first quarter. According to the NBS, 5.36 billion litres of petrol, 1.56 billion litres of diesel, 8.73 million litres of household kerosene, 283.90 million litres of aviation fuel, 23.36 million litres of LPFO, and 290.24 million litres of LPG were distributed nationwide during the period under review. And the International Air Transport Association says Nigerian Airlines lost $2.09 billion in April and June. This is contained in IATA's report titled Quarantine Measures Threaten Aviation Restart in Africa and the Middle East. The report noted that aviation was the worst hit sector in Africa and the Middle East, with more than 8.6 million jobs at risk. According to the report, passenger numbers in Nigeria declined in April and June by 4.7 million and 5.32 million each when compared to the corresponding periods in 2019. It says 125,400 jobs were at risk in April, while 139,500 jobs were estimated to be at risk for the month of June. Mohammed Al-Bakiri, IATA's Regional Vice President for Africa and the Middle East, has asked for alternatives to government-imposed quarantine on Africa and Middle East countries as it affects the profitability of the travel and tourism sector. Now, in the first half of this year, the Nigerian debt capital market saw no fewer than 14 corporate primary markets activities across the Nigerian Stock Exchange and the FMDQ Securities Exchange. These range from a mix of corporate bonds to commercial papers, which have attracted more issues lately due to the low-yield environment and the reduced appetite for credit. But why the demand for commercial papers and bonds among Nigerian corporates, despite the crowding out of effects of government securities? How sustainable is this mode of capital raising exercise for companies, and what are the chances of redeeming the debt as and when due? These are some of the questions that the head of portfolio management at Commercial Partners Asset Management, Victor Aluyu, will be answering. Good morning, Victor. Thank you for joining us.
Morning, Chimezi. Thanks for having me.
Now, since the year started, we have seen about 6 corporate bonds issues from the likes of Flour Mills, FBN Quest, Dangote Cement, and so on, plus the very recent one, Lapo Microfinance Banks, that was a 6.2 billion naira bond program. What do you think is fueling these demands for bonds?
Well, I mean, like you mentioned in your introduction, we've over the years seen a crowding out, effects of the corporate sector by, government debts. But I think what you're seeing essentially is a reaction to the declining yield environment. Corporates always seek optimum and efficient ways to raise their financing needs. So if the yield environment permits them to raise money significantly cheaper than they probably would have maybe a year or 2 years ago, it only makes sense, for them to do that. And that's the reason you're seeing a flurry of issuances that you have seen so far this year. The environment is rife for that. It encourages that, and obviously gives great incentive for corporates to come and tap that debt market. So I think the declining yield environment creates a great incentive for corporates to continue to tap the debt markets.
Now, in terms of commercial papers, this appears to be the most attractive segment of the market lately. In fact, some companies have had to float bonds and commercial papers back to back. How significant is the low yield environment of this instrument for these issuers?
Well, I think for the commercial paper market, we've seen that actually rising over the last 3 to 5 years, when in 2016, total commercial paper issuance was about 114 billion. By the end of 2019, the total issuance was over 300 billion. Right now, year to date, we have over 200 billion, in commercial paper that has been issued. Again, the dynamics within the yield environment, which essentially allows corporates to be able to take care of their short-term financing needs at a significantly cheaper rate that they probably would have been able to a couple of years ago. So it really just makes sense and gives corporates great incentive to take advantage of this low yield environment. Like you mentioned, you've had some corporates issue commercial papers, and I've also gone ahead to issue bonds as well. So there is great incentive for them to continue to tap the local debt market and also the local money market to be able to raise funds as cheaply as they can. So again, I think that the declining yield environment and also the sort of amount of liquidity within the system that is looking for instruments, that paucity of instruments as well, creates a great incentive for corporates to be able to come out and raise money at these levels at this time.
Now, but won't some of the listed companies consider offering like right issues or even private placement instead of commercial papers?
I think the challenge with that has been the state of the equities market, or what you might describe as investor appetite towards risk assets or equities. Over the last couple of years, really, that has been subdued or been on the decline. We've seen some flashes of recovery here and there in the market, but on a sustainable basis in terms of how investors perceive the risk in that market, it's not been strong for a couple of years now. And that's the reason a lot of corporates would shy away from doing a private placement or even looking to the equity market to raise funds. We've had some right issues, a number of right issues over the last couple of years, but I think that the preference really right now is for the debt capital markets because of all the kind of liquidity that is in there, the paucity of instruments in there, and of course the sort of risk averse nature of investors towards equities at this time makes it preferable that these funds are raised in the debt markets.
We know so far about the performance of the commercial papers on the secondary side of the market at the FMDQ exchange?
Well, I think that's one of the challenges that we've had with, corporate bonds and even commercial paper issuance. It's always been around, that price discovery and liquidity in secondary market trades, if you will. Because of the size of the issuance there, it's typically not very liquid and such that it doesn't easily trade. Most of the trades that you probably have there are essentially OTC trades. So price discovery remains a bit of a challenge. And I think the reason for that is the seeming illiquid nature of these corporate issuances. But I think that as you have more corporate issuances and as you also have corporate issuers create a bit more liquidity in the papers that they issue, I think that situation should improve, and then we should have better price discovery going forward there.
Well, speaking of the offers to investors, they are more targeted at deep pocket investors or high net worth investors, usually at a minimum of about 5 million naira per subscription. Now, except for that of MTN, which was offered at a minimum of about 1 million naira. What can the regulators do, to make this instrument participatory for retail investors?
I think if we take a cue from what the DMO has been able to do with the federal government bond, particularly the creation of the federal savings bonds, I think that we would be able to draw lessons to see that in terms of a structure, market structure that can be created to push this sort of instruments to retail investors. The structure is there. I think that in terms of regulation, maybe the regulators need to come out with a framework that enables issuers to be able to extend these instruments, to retail investors via some sort of structure that would enable retail investors to participate. Because again, that retail investor market is quite significant. It is quite large. And I think it is important that they be exposed to such investment vehicles as they come out.
It also appears that the commercial papers are more of the FMDQ exchange and not available on the NSE. Is there any reason for such limitation?
Well, I think it probably has to do with some maybe listing requirements. I would also believe that the NSE is in constant communication and discussion with these issuers, because at the end of the day, it is important that these issues are liquid and tradable, particularly from a secondary market perspective. That would serve to significantly deepen the capital market and also provide investment outlets and opportunities for investment funds and also retail investors as well. So I want to believe that there are discussions in the works to ensure that this situation is taken care of, and a platform for retail investors and for the tradability of these securities is made available.
All right, now, given the reemergence of liquidity challenges in the financial system lately, what are the chances that issuers will not default in redeeming investors' principals at maturity?
I think the issue with or the challenge with issuers, meeting up those payments would essentially be around, the broad macro situation. For instance, what we've had for the first half of this year with the whole COVID-19 pandemic and its attendant impact on, the economy would certainly speak to, stresses, particularly for some of these corporates, and obviously could have some impact on their ability to meet those interest payments or even the principal payment at maturity. But again, I believe that there is room for some sort of negotiation in those areas, particularly with the creditors. So clearly, I think, the ability for issuers to repay pretty much is dependent on what is going on with the macro situation. For issuers who probably have their maturities coming up in 3, 4, maybe 5 years from now, I think that barring any significant economic contraction or any other black swan events from the global economy, we think that they will be okay. But for those that probably have redemptions or close by, they might have to do some sort of renegotiation with the creditors. But I think it's the macro situation that would really determine that, not so much around the sort of liquidity that you have in the system, because that is basically tied to the performance of the companies and how they are able to generate the returns and also get the funds to be able to pay back when these papers mature. So I think it's really tied to the macro situation and not so much around liquidity.
And with inflation accelerating at double digits at yields on the commercial papers, net single digits, do you see anything changing in the second half of the year?
Well, I think, for the second half of the year, a lot is really dependent on the developments on the COVID-19 front. There have been talks or indications of a likely second wave or the reemergence of a poorly managed first wave. I think a lot depends on how significant that would be. If we see cases continue to rise and we see governments lean towards reinstituting restrictions on the economy, that would have a significant impact on the output growth for the second half of the year. However, if we're able to manage the situation as it is now into the better part of the rest of the year, I think we will see some gradual improvement in output and by extension to the general economy. So I think a lot depends on what happens on the COVID-19 front, really. But in terms of the local market, the amount of liquidity that you've got coming through again will play a significant role in driving those yields. Inflation is where it is, but I think what is happening right now is you have a significant paucity of instruments and you have quite a lot of money looking for outlets. So that will continue to drive those yields, downwards in our view for the remainder of this year.
All right, thank you very much, Mr. Aluyi, for your time. Victor Aluyi is the head of portfolio management at Commercial Partners Asset Management. Thank you for your time.
Thank you.
Well, the Nigerian banking sector has come on the radar of global rating agencies recently. Fitch Ratings in a recent report projects that banks' loan growth from 14% year-on-year in 2019 to 2.5% in 2020. That's not all. Moody's Investors Service, on the other hand, warns that banks could face foreign currency shortages as a result of low oil prices, volatile foreign inflows, and lower remittances. To unpack all of these for us and their implications, the financial and management consultant and the CEO of Flame Academy and Consulting, Mr. Orji Udemezue. Thank you very much, Mr. Udemezue.
Thank you. Always my pleasure to be here.
Good to have you here. Well, first, let me get your own assessment of the Nigerian banking system so far since the COVID-19.
Oh, well, Nigerian banks are doing their best to cope with this situation. You find that anytime you have a crisis in the economy, anytime you have slowdown in economic activities, naturally banks will be affected because the banking sector is a sector that coordinates activities in the economy. Every settlement done in the economy, whether in agriculture, in oil and gas, in manufacturing, solid minerals, they're all done through the banking sector. And they thrive in collecting deposits from these sectors, the surplus sector of the economy, and then advancing credit on the other side. So once activities are low, the intermediation in the financial market will also be low. And mind you, anytime you have economic stress or crisis in an economy, it always dovetails into a financial crisis and vice versa. So we expect that with the COVID-19 adverse implications on several economies around the world, not just Nigeria, we expect that the banking sector around the world, globally, are going to have challenges. How fast these challenges are resolved depend on the local authorities, fiscal policy authorities, monetary policy authorities, and the leaders in this banking sector. So if you look at the Nigerian banking sector, it's borne some kind of swing up and down. When we tried to survive the global financial crisis that bedeviled the whole world in 2009, 2010, we struggled to come off it, and we're doing well until we now had the 2016 recession, which saw asset quality in banks deteriorate seriously. And in fact, the average non-performing loan ratio climbed towards 20%. Then coming down to around 11% last year. And then this year, we saw it coming close to 6%, a single digit. But I'm afraid with this COVID pandemic, we're going back to where we came from. We're likely to cross, from estimations from several experts, we may cross double digit again in non-performing loan ratio for the banking industry, which is not a good news for the sector.
Anyway, that brings us to what Fitch is talking about here.
Yep.
Of course, Fitch is saying that banks' lending will plunge by as much as 2.5%. That's from the 14% that was recorded in 2019. And of course, Moody's is also saying that banks could face foreign currency shortages. I guess we'll have to take a short break. And when we come back, we would...
we'll look at Fitch. And then Moody's.
Absolutely. These two are projections. All right, we'll take a quick break. We'll be back and continue with this conversation. To stay with us. Thank you for staying tuned. And we're talking about the Nigerian banking sector. And I still have here in the studio with me Mr. Orji Udemezue, Chief Executive Officer of Flame Academy and Consulting. Thank you very much for sticking on.
Always my pleasure.
And of course, before we went on break, we were talking about Fitch and Moody's projections on banks. What do you make of these projections?
You know, Fitch ratings, Moody's, and then Standard & Poor's, and even locally we have Augusto rating. These rating bodies are always looking at, either the economy as a whole or some segments of the economy, very importantly the financial sector, to say this is how they see things playing out in the near future based on certain factors in the economy. So, and they do this around the world, not just in Nigeria. So whatever they say, are pointers to what we expect to see. They are not 100% correct, but they are based on some algorithms, some surveys, some facts fed into some data, analyzed, and then brought us some projections, to say that this is what they expect. So it depends on that sector or that economy to work very hard to avert a dangerous projection or joyously expect a very good thing to happen in the future. But now they're saying there's a drop in credit, which of course makes common sense, because with the COVID adverse effect on the economy, you don't expect credit to grow at the pace it had been. In fact, the net growth in credit was about 14% last year, and it was expected that this year we would do 16%. Mind you, growth in credit given to the economy is a sign that the economy is getting better and better, and that that activities in several sectors are getting the blessings of banks in terms of supporting these projects, whether for project financing, infrastructure provision, term loans, and all of that for investing in fixed assets, or working capital provision, even in some cases also supporting government activities. So from 16% expected this year, Fitch is now projecting a 2.5% growth. So we should even just thank God that we still could expect some growth. Otherwise, the way things are, if you look at the worst case scenario, Nigeria can actually have a serious decline in net credit given to the economy. That is, instead of a growth of 2.5%, we may actually see a deficit if care is not taken. Because many banks, and I'm very sure, sure what I'm telling you right now, have actually cut down lending to several economies. But because we have a system that's a bit unstable and skewed to some kind of credit concentration, you might still see some kind of growth because most of the lenders in Nigeria are actually the multinational companies and big corporations who might spring up to activities very soon. You have an economy where only about 400 people in this economy in Nigeria, account for nearly 80% of loans given out at the corporate level. That's very sad. That means the SMEs, the middle class are actually missing in the radar in the lending in Nigeria. So, I mean, and we have to begin to deconstruct this situation so that whatever happens, you can see that the economy can actually, have activities in lending and all of that, which are depending on these multinationals. And you also have a case where only about 2% or 3% or 200 million Nigerians keep up to 500,000 naira, in their accounts, which is very sad. So all these have to be looked at. The Nigerian banks with the regulators, the central bank, must look at policies, smart policies that can rebalance this situation. And
that brings us to the issue of this cash reserve ratio.
Requirement,
now, yes, looking at this Fitch projections, talking about cash reserve ratio is about 27.5%. Now, is it not time that perhaps the central bank looked into this issue, probably bringing this down?
Very intelligent question, very smart question, but can we actually do this? Nigerian Central Bank has become the sole carrier of the burden of driving economic growth in Nigeria. I don't pity them. Each time you have this monetary policy committee meeting, I pity those 10 or 11 members who have to gather and think about how do we make this country progress. I've said this here several times. Even Central Bank on their own about 2 years ago had, cried that we had got to a point of monetary policy exhaustion. And I can assure you right here and now that we're still pretty much at that level of monetary policy exhaustion. Fiscal policy in Nigeria is doing next to nothing to support this economy. Government, central bank has to do all kinds of abracadabra, magical things, including forcing banks to lend about 65% of their, deposit,
LDR,
out. The LDR ratio of 65%. It's all magical things.
Now, even that one, shouldn't it even be, reviewed, considering that, yes, That helped the banks to actually issue out credit, but non-performing loans
are going to climb over time. You know,
growing.
see what's happening here. The central bank is very concerned about lending in the economy, and they want to drive it. But instead of driving it through moral suasion, they are now driving it through moral and regulatory compulsion on banks. And banks are just, between the devil and the deep blue sea. Because, okay, let me just give a simple analysis here. When you collect a deposit, just without looking at other factors, I know there are other factors that can enable the lend, but for a common man, let's look at it this way. You collect 100 million from a customer. Central bank says you must keep 27.5% of that money with them in a sterilized account with central bank, 27%. Then you must also keep 30% in liquid form. You must not lend with that as in what you call the liquidity ratio requirement. What is that already? I don't want to look at other factors, other costs of that fund you bring in. That's about 57%. That must be kept in cash. You must not lend it out. So how come now you come back and say these banks must lend out 65% of this deposit out? That means 65 plus 57 is 100. So they must have to find money outside the deposit they collect from customers.
I actually saw a headline in one of the papers this morning that says that for every 100 naira deposit, about 60 naira is idling away with the central
I just told
bank.
you that.
Yes.
I just gave you two now.
Absolutely.
30% liquidity
so
ratio
even if these
requirement.
banks would want to learn,
They have to do magic.
yeah,
And mind you, the major lever, monetary policy tool or lever to bring about liquidity in the economy and allow banks lend is the cash reserve. That's the one that works like wildfire. Once you bring, Nigeria has one of the worst cash reserve requirements in the world. 27.5% is crazy for an economy that needs to support the real sector and enable banks give out loans. It is crazy. Everywhere around the world, even in Africa, in some nearby African countries, you don't have CRR above 10%. That's the way to go. But why am I saying that? I mean, you can see central bank saying CRR should hang at 7.5%, then we bring down the monetary policy rate to 12.5%. That's crazy. If you're actually doing monetary easing, the most important instrument to ease from is CRR. The monetary policy rate is more like a guide in the economy too. And by the way, there are several issues. I don't know if we can discuss it here. How can you have an MPR of 12.5 that is almost the same as your inflation rate? In fact, inflation rate is ramping up to 13%. That means in the economy as a whole, the average interest rate in the economy is negative. You can't bring in liquidity, particularly from foreign investors, in that situation. And they know. But, they are, like I said, they are between the devil and the deep blue sea. They don't know what to do again. So my point is that fiscal authorities must begin to help the central bank to ensure that we have a medium to long-term growth in this economy. How can they do that? First of all, they must roll out policies that must ensure that every item in this country that we can produce locally, that we're able to maximize the production and stop importing them. And all these things about oil and gas, importation of petroleum, we must end that. How do we start some modular refining activities? How can we stop the consumption of imported oil and gas products? Because if we do that alone,
well, the central bank has been advocating backward integration. I mean, we can give it to them.
Like I said, central bank has become both the fiscal policy authority and monetary policy authority. Even the anchor borrowing, I don't blame them. This is a very tough time to be a central bank governor. What is our Minister of Finance doing? What is the whole finance architecture doing? What are we doing to improve infrastructure, to boost local production? What are we doing about electricity? There's no energy supply in this economy. And this is constraining lending by banks because banks cannot open their eyes and give loans to sectors that know are struggling to make profit. You produce an item, you have to almost 30% of your cost is in energy production. I mean, energy supply. You produce your own power, you produce your own road, everything, and you cannot compete with so we keep importing and importing. Central bank cannot solve that part of this problem. The government of this country has to find a way to provide electricity, provide other infrastructure that will enable SME growth. Mind you, part of the problem we have in the banking sector is that the banks are always looking at how to make money. And the only viable sector for them to make good money, like we're coming to Moody's assessment of low deposit in foreign, is because the 30% of exposure in the banking sector is in oil and gas sector.
Absolutely.
The loans giving out by banks is 30% oil and gas loans. And once you have this drop in crude oil price, banks get their fingers burned. But can they help it? When next you have a rise in oil price, they get in there again and get over-risked. And each time again you have a slump in price, we come back to a place where our NPL ratio will climb up again. So it becomes a cyclical wave that can never stop. until we open up other sectors of the economy. We have an export ecosystem that is unpopulated. How can these banks and the central bank populate the export ecosystem? So we can expand export in agricultural products, vegetables, grains, even solid minerals, and all of that. So that you find that banks' overdependence on the oil and gas sector to lend and make profit, because banks must lend anyway. If you choose not to lend, you're no longer a bank. You must lend. But where can you lend to? And again, I'm coming to what banks must do to enable us to come out of this situation. In case we have 5 minutes again to discuss, banks must drop the lazy banking attitude. By the time I finish what they must do, we'll talk about what central bank must do too. They must drop the lazy attitude towards SMEs. Most of the loans you find in the banking sector, apart from the ones they give to the big corporations, they are all salary-based loans. SMEs who have great projects, great ideas and dreams, get those dreams unfunded. You have trapped talents, trapped dreams, unfunded dreams, because banks are risk-averse when it comes to SMEs. And mind you, no economy can grow beyond what we're doing right now in Nigeria. No economy can develop without a very active SME sector, supported by infrastructure development by government and power supply. Nigeria has the single most important risk to our SME growth, power supply. If it is solved, trust me, there will be more opening for banks to lend. And perhaps the Fitch estimate of 2.5, we can overcome it. So there's a lot banks can do. If I have 5 minutes, I can run through it. But it's very, very critical. For Fitch, for Moody's estimation about drop in the deposit, that is based purely on the drop in the oil prices.
Yeah.
And unfortunately, these prices may stay within the region of $45 per barrel in the next 6 to 1 year from estimations. Even though U.S. is struggling with their shale production, but a number of other factors are likely to continue to bring downward pressure on oil price. So we see it at about $40 per barrel today, and it's expected to hang around there for quite a long time. And that's not good for Nigeria, looking at our cost of production and other factors.
Okay, let me take you back to what you said about banks being more exposed to the oil and gas sector. Yes, those guys are saddled with a lot of non-performing, assets
right now.
Yes, so considering this
despite
situation,
unbundling a lot of them,
so
last year.
what should be the way out right now for the banks? A lot of them are calling for moratorium or perhaps debt cancellation.
Where banks are already exposed to this sector, the only way forward is to apply the best method in loan monitoring and loan remediation to ensure that all loan officers, managers, and so on are on top of their game, monitoring, knowing what to do. Not just going to harass the customer, threaten them to take them to court, but find out how you can wait it out, how you can restructure, how you can handhold them through this whole situation, supporting them in the initiatives they're making to deliver more revenues. Otherwise, it's going to be a long wait. You can't force them into paying you. If they have assets that are not performing, they're not producing and all of that, and you've sunk in, long-term, because this is usually, infrastructure financing loans, maybe to, build a new oil facility and all of that, tank farm. It takes average of 2, 3, 4, 5 years to get these loans repaid. So you can't rush them to pay you, because these monies are tied in long-term assets. You must have to wait it out, work it out with them to find a way to generate revenue. And hopefully, like Nigeria has always hoped, the oil price might tank up again. But if it doesn't, it's a real bad situation.
Now, just a quick one. Would you advocate for perhaps a stress test for the banks?
It's something that central bank already does normally, all the time. If you stress test most banks right now, you find that not all of them are very strong in terms of capital adequacy and asset quality. But that's expected. I don't expect central bank to take any rash decision based on those tests. But of course, those tests will enable them know where there are weaknesses and enable them, work with these banks to overcome these weaknesses. Let me just run through, if I have a minute or two, a number of things that the sector must do right now to get us out of this situation. One, risk management by banks must be, strengthened at this point. Banks can ill afford to abuse the lending process at this point. Both the credit policy guide and everything about their lending, the procedures must be strengthened. But altogether, banks cannot afford to also be afraid of lending entirely, because that will affect their profit. Several factors are already affecting their profit in the next 1 year. In fact, I expect to see a lot of profit alarms by the financial service players in next year. Like I've said earlier, banks must please become more strategic in the way they deal with SMEs. Several guys in this economy, several people have great ideas, both in IT, in production, agricultural, even in exporting, but they lack funds to this, and we don't have venture capitalists, capitalists here. Banks are the closest friends they can find, even connecting them to CBN kind of funds. But that's not happening. We need to, ramp up activities in SME because when the SME pie gets larger, banks have more business to do.
All right, thank you very much, Mr. Udemez. Well, let's just hope we get it right and perhaps avoid the ticking
We keep
bomb.
praying, sir. Nigeria is a great nation. We'll get things done well.
Okay, just before we go to Temple, a quick look again at the global oil market as crude prices fell in early trade this morning as the resurgence of the coronavirus globally and in the United States, the world's largest oil consumer, dimmed the prospects of fuel demand. Brent crude futures were down 37 cents at $42.77 a barrel, and U.S. West Texas Intermediate crude futures fell 34 cents to $40.31 a barrel. Both benchmarks rose more than 2% on Thursday, buoyed by stronger than expected U.S. jobs data and a fall in U.S. crude inventories. For the week, Brent was up 4.3% and WTI was up 4.7%. However, increases in the daily cases of the coronavirus globally and in the United States pressured prices. New U.S. COVID-19 cases rose by more than 50,000 on Thursday, setting a record for a third consecutive day. And for a review of Thursday's trading activities at the equities market, here is Temple. Temple, I guess it's been a roller coaster week for the equities market. Down, up,
zigzag,
down.
zigzag, actually,
Absolutely.
zigzag. But I mean, that creates some room for re-entry, actually. That's what I keep stressing. And that's something that investors should start looking at in the markets. Yes, yesterday, we didn't do 1% down. No, it was 0.90% decline. And that just translates to 115 billion naira worth of exits from your equity capitalization, which now reduced to 12.715 trillion naira. But of course, look at the volume of transaction, 180.12 million. That's 9.05% drop from what we did in the preceding trading session. Of course, UBA constituted a larger portion of the top trades that we saw yesterday. That's because we saw some sell-off and a bit of profit-taking that brought down the price of UBA by some 81 basis points. Some 24 million units of its shares constituted what you have in this 180 million naira. And of course, the value was around 153 million naira out of the 1.84 billion naira worth of transactions that we saw here yesterday. Now, if you look at this is a 78% growth, actually, compared to what we did in the preceding trading session, and deals was 3,889. Now, let's take a look at the color that we have now under the sectoral performance of the market. It was all red, and that's because we've been seeing so much of sell-off in the market, but there's also a little bit of profits-taking touch on this, because again, if you look at what the pharmaceutical companies have been doing lately, that's somewhere where you have a lot of attention. The healthcare stocks are so very, very lucrative right now. We're talking about the likes of GSK, which was down yesterday by 10% out of the 24 losers that we had in the market. But if you look at the other side of the market, the fact that we had just 7 gainers, Name-It led, actually, and it was up by more than 9%, 9.4%. There you have a lot of interest in recent time healthcare, because yes, the CBN has given this guy some loans, some 2.5 billion naira, FeedSyn, Name-It, May and Baker. That's where you have a lot of interest, but that's because you have a lot of investors, that are smart enough to think to go that way. But banking stocks yesterday were down 4.58%. Sterling Bank was down, FCMB, GT Bank, Zenith Bank, major names were down. Here too, you got Unilever was down, PZ was down, Flour Mills was also down by 5%. Industrial goods side of the market, WAPCO fell. Insurance side of the market, a lot of profit taking on this space. Oil and gas, of course, not doing well too, because again, there was a bit of profit taking on O&O yesterday. And that's what we have under the energy stocks here. O&O was down 3.36%, but with Georgia Paul, which is a very mild company in the market, they're up yesterday by 9.52%. But we have Jamiu Kayode on phone joining us. He is a trader with APT Securities and Fund, a member of the Nigerian Stock Exchange. Jamiu, thank you for joining us on the program. But let's look at the fact that we've seen prices dropped so low at this point in time. But how much of opportunity does that give to investors who are willing to take long-term position in the market?
Thank you, Temple Asaju. I'm very pleased to be here on the program. What we're having right now is downward trading in the market, and that shows that it is a high time for investors to be very, very careful, and also to take a decision to have a long-term horizon into investment in the equity market. So, firstly, they have to take a long-term investment horizon in the market, and also they have to invest wisely in some of the sectors that are very good for now. As you have rightly said, as you have in the healthcare sector, you see the trend in there. You see telecom and logistic companies in the market. All these stocks are the ones that we are expecting the investor to look into. Mind you, what is affecting our market is just about two things. Activities in the FX market and also the COVID-19 that has happened in the second quarter of the year. People are selling in anticipation that the result that will come out from those the companies are not going to be encouraging. That is why they are selling down. So what we have now, what we are expecting investors to do now is to invest right now. Take a decision, put a long term of horizon in their investment strategies, and also look at those sectors that they think it can get them to a good return.
Basically, investors should start keeping their eyes on the ball at the longer end of the curve. Thank you so much, Jamiu Kayode, as a stockbroker with the Nigerian Stock Exchange, trading with APT Securities and Fund. Back to you now, Chimezie.
Well, for those who are ready to take the risk, go for it. We'll take a quick break. When we come back, we do an opening call to London as well as the debt and currency market with Temple. Just stay with us. And for updates from the streets of London, here is Juliana Olainka. Good morning, Juliana. Well, HSBC and Standard Chartered Bank risk being caught up in the geopolitical struggle between the U.S. and China after the U.S. House of Representatives passed legislation targeting Chinese officials involved in implementing a national security law in Hong Kong. Banks who do business with officials involved in the security law could face sanctions. How are investors reacting to this?
Good morning, Chimezie. It's an interesting story and one that's set to grow as this Hong Kong-China standoff gets increasingly tense. What we know is that on Wednesday, the US House of Reps backed some new legislation that's also been passed by the Senate, which seeks to crack down on Chinese officials, including police units, individuals that are supporting these new China national security laws, as well as people that do business with China that affects Hong Kong. And basically what America are trying to do is impose sanctions on these individuals as a response to these new China national security laws. Of course, HSBC and Standard Chartered, who have significant influence in Hong Kong and do lots of business there, even though they are headquartered in London, they have been caught up in this row because they were the first kind of offshore companies to back and support China's increasingly scrutinised bill. Dominic Raab, the UK Foreign Secretary, on Wednesday pretty much slammed them in his discussion in the House of Commons. He said that these banks are putting profits over the rights of Hong Kong citizens. And of course, on that day, Britain extended residency to any Hong Kong national that wants to leave Hong Kong. So it's pretty messy, but China is being warned by the UK and by America and other allies across the West that if they do try to crack down more on Hong Kong, then there will be serious repercussions. China have responded. I believe their foreign ministry spokesperson was delivering a speech earlier this morning to the press, and they said that if this bill does indeed get passed and signed in by Trump, which of course we're expecting, then there will be visa sanctions on any American tourists trying to come into China.
And Primark is going ahead with plans to open 5 new stores in the US, France, and Poland, despite economic uncertainty over the coronavirus cases. What is driving Primark's optimism this time when other high street brands are cutting costs and laying off staff? Yeah, well, we discussed this, didn't we, yesterday? I think Primark, associated
Associated British Foods, which are the company that own Primark, they did a trading report yesterday, and it did show that they have been doing increasingly well, even though they did say that they expect the end of this year their profits to be down by a third. So at this period last year, I believe profits were about £930 million. They will reduce to about £330 million. They've been pretty convinced by the reopening of their stores here in England. There were scenes of pretty much chaos. Primark mania, Primani mania is still very much in force. People were queuing for hours on end. And they have said that the opening trading reports that they've seen over the past couple of weeks have been really healthy. So they are going ahead with this expansion. I think what's pretty much different from Primark, if you compare it to its competitors, number one, of course, is the price point. It's much cheaper, and I think their clothes are increasing in quality. But number two is that they don't have any online presence. So that cost them about £650 million each month that they were closed. And it possibly because of this lack of online presence, customers are rushing to their stores. They know they can't access it online. So there is an increase in their footfall. So yesterday they did announce that they will be opening up 5 more stores again in US, France and Poland. And shareholders reacted positively to that announcement because their shares yesterday were up 4.5%.
And are there other developments on investors' radar this Friday?
Well, there are. We actually just about half an hour ago, we received the UK PMI services figures, and I believe UK services PMI is up to 47.1. It was 29.0 in May. It's 47.1 in June, which is a significant jump, even though 50 is that benchmark. So anything below 50 is still a contraction. We can see that at least the British economy is starting to tick again. This is going to really weigh in on investors, and it will be interesting to see if the FTSE picks up at intraday, because of course tomorrow, which is being called Britain's Independence Day or Super Saturday, is the day the hospitality sector opens up. And hospitality is the biggest contributor to British GDP. Prime Minister Boris Johnson has already told people to take it easy, but there will be increased police presence on the streets of the UK, well, England, up and down tomorrow, because I think officials are expecting it to be the kind of scenes we're used to seeing on New Year's Eve. So expect a lot of really interesting pictures on Sunday morning, Jimmy.
All right, Juliana, see you later for update. Thank you. And back to you, Temple, for the debt and currency markets.
Yes, don't always forget. And Chimeze, you also have the NASDO to say on listed securities market. I mean, here there was opportunity for profits taken yesterday on Afriland security, which is tradable on this platform. It dipped by some 10% yesterday only. Of course, look at the market capitalization, which hovers around 525 billion naira. Is now 520.68 billion naira. It's profits taken. 10,000 units of Afriland was traded yesterday. It opened at 2 naira 20 kobo and dipped to 198 naira or thereabouts. Of course, you had those folks that sold, probably buying the likes of Farm Milk, which makes a lot of yogurt at the retail space there. And of course, 130 units of one of the other major companies. I'm sorry, I can't remember that now. But basically 3 deals yesterday. And of course, 34,890 naira worth of transactions yesterday in the markets. Now, look at the debt and currency side of the markets. Here, we got a lot of demand yesterday. The bullish buyers that we saw on the bond side of the markets yesterday was really interesting. We've got a lot of interest on the 17th of March 2027 paper. That's at the mid-end of the curve. And then look at the 26th of April 2029 paper at the mid-end of the curve as well. We saw a lot of interest. 27th of April 2023 paper, which is at the shorter end of the curve, we got a lot of interest. This is now trading at 120 naira, having risen from 118 naira 50 kobo the day before. Now look at the 2029 paper. It was actually trading at 135 naira before now, and then it jumped to 138 naira 25 kobo yesterday. Look at the 2027 paper. It was 140 naira the day before. Now it's 142 naira. Now we saw so much of gains here yesterday, and that explains the bullish bias that we saw in the market. But we had a total of 13.35 billion naira worth of transactions. The NCB side of the market, not so much of activities yesterday, just less than 50 million naira in transaction. OMO, yesterday we saw more interest at on the January 2021 paper. That's at a bit of the mid-end of the curve. But we have Bankole Odusanya, a fixed income dealer with UBA, joining us on the program this morning. Thank you so much. We know that there was OMO auction yesterday in the market, 157 billion naira worth of transactions. Talk us through how that panned out and how that will now impact the secondary side of the markets today.
Thank you, Temple. 157 billion matured. These are fresh funds that came back into the market. However, the central bank sold only 100 billion, meaning that there was excess funds chasing the few securities. What this has done immediately today in the market is that very few of rows of this security have showed very low yield. The particular bill that you have mentioned, 8th of June 2021, stopped at the auction yesterday at 8.99. But today, we are seeing that the offer is as low as 5.5% in the market. This is in continuation to what we have been seeing in the last few weeks, where the small funds chasing after a few securities. The impact has also led to drastic yield drop and increased price on the bonds end also, with greater impact on the short end of the bond curve. If you look at the long end of the bond curve, the bonds that were at in 30 days ago at 12% are now at 10.9. It's that serious. By way of pricing, the implication is more than 10 naira movement in price upwards.
All right. Bankole Odusanya, thank you so much for your insights there. We appreciate them. Bankole Odusanya is the head of fixed income with UBA. That's one of the major banks that we have here in Nigeria. Chimezie, back to you.
Thank you, Temple. Well, we've got to go. Thank you for watching. I'm Chimezie Obi Iwago.